the profit margins. So we have profit margins, profit margin. We have assets turnover, etc., etc. How do we measure performance of an entity using these models, using these ratios? Number two, ladies and gentlemen, in terms of performance appraisal, never forget our commonly asked balanced scorecard model. Balanced scorecard model. Number three, we have the famous Fitzgerald and the moon, building blocks, and the moon building blocks, and the moon building blocks. And then number four, ladies and gentlemen, lastly, we have the performance pyramid. So if we're to go through this quite fast, my great students here, who is able to remind us the formula of getting ROI? ROI stands for what? ROI stands for return on investment. ROI stands for return on investment. ROI stands for return on investment. I want to see from your comments here. The board is not clear. Are you able to see the board well? Are we able to see the board well? Not clear. Let me see.
Let's go to 800.
800, yeah. How is it there?
It's clear, but from the side.
On your side, are you able to see my board clearly now?
No, still not here.
Still not there.
Blood.
That's worse.
Let me help you.
Sorry for that hiccup. We have to send it well before we continue. We can only continue after you say yes. Put the camera where it was when we were joining. Is it okay now? Is it okay now? Yes, thank you very much. Thank you very much. Great, great. So repeat number three. Number three is Fitzgerald and the moon. Fitzgerald and moon, building blocks. Fitzgerald and moon, building blocks. And then number four, we have the performance pyramid. 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 Now we were here, they want us to give them the return on investment. Return on investment is also known as what here? Return on capital employed. Return on capital employed. Return on capital employed. This is also known as the return on capital employed. And if you can recall very well, to get this return on capital employed, also known as ROI, to get return on capital employed, also known as ROI, ladies and gentlemen, we normally work with the operating profit. So here we have the operating profit all over the capital employed, all over the capital employed. Operating profit divided by the capital employed. Operating profit divided by capital employed, divided by capital employed. And then remember that this capital employed in a firm, capital employed in a firm is the same as what here? Net assets. Capital employed in a firm is the same as net assets. And ladies and gentlemen, to get net assets, to get net assets, to get net assets, to get net assets, we normally take total assets minus current liabilities. 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 Justin says that something needs to be done on the camera. Is it the one that is? Because I want to go to this question. Okay. Question number 5. What could be the problem today? Or perhaps it is a network. The camera is clear. On my side, it's clear. It must be network for some of you. It's clear. Yeah, it's clear. It's clear. Thank you very much. So to get net assets, ladies and gentlemen, we normally take total assets minus current liabilities. For us to be able to understand this very well, I have a handout with me here, which I'm displaying question number 3. Question number 3. I just display for them. Question number 3. Question number 3. Question number 3. Question 3, just go down. Question number 3. Yes. Are you able to see that question? Question number 3. So we are reading, ladies and gentlemen, we are reading together there. Brace Company is a large software company specializing in the development of computer games and the software products for commercial applications. Historically, the company has used solely financial performance measures to assess the performance of the company as a whole. Brace Company is split into 2 divisions, A and B, each with their own cost and revenue streams. Each of the divisions is managed by a divisional manager who has the power to make all investment decisions within the division. The cost of capital for both divisions is 12%. Please underline for me. Cost of capital for both divisions is 12%. Historically, investment decisions have been made by calculating the ROI of any opportunities, and at present, the return on investment of each division is 16%. A new manager who has recently been appointed in Division A has argued that using residual income to make investment decisions would result in better goal congruence throughout the company. Each division is currently considering the following separate investments. We have project for Division A. We have project for Division B. I can see the capital required for each division. I can see the capital required for each division. I can see the sales generated by investment, and then I can see the net profit margin for the divisions here being given as 28% and at 3%. So they want us to calculate both the ROI and the residual income of the new investment for each of the two divisions, for each of the two divisions, for each of the two divisions. So that is a nice examiner. This is a great examiner, a great examiner, a great examiner. Remember, the way you are seeing that, you're seeing like two screens, eh? There is a handout there, and then there is a small screen for my face. You can see my face over there. So as a good student, you need to know how to move between the two. If you want to watch, for example, Mwalimu writing something on the board, you tap on the video. You tap on the video. So you keep on navigating. If you want to see the handout, you tap on the handout. You tap on the handout. So here we are. They want us to calculate both the ROI and the residual income of the new investment. Now, ladies and gentlemen, we start with ROI. How do we get ROI? How do we get return on investment? Return on investment, you say, we normally work with the operating profit. Operating profit all over the capital injected, all over the capital employed. Capital employed. Ladies and gentlemen, remember that operating profit is the same as profit before interest and what year? Before interest and tax. It is the same as profit before interest and taxation. So I can see the capital that was employed for each of the divisions. I can see the sales generated by the investment, and then I can see the net profit margin. So ladies and gentlemen, from this net profit margin, I expect somebody to give me a formula which will be able to help us to get this operating profit. To get the operating profit out of the net profit margin, to get net profit margin, ladies and gentlemen, remember what we normally do is to take the profit before interest and what here somebody? Tax. Divided by sales. Net profit margin, we are repeating again, this is profit. This is profit divided by sales. Profit divided by sales. But remember specifically, for net profit margin, which profit we normally work with? It's PBIT. Profit before interest and the taxation. Now, ladies and gentlemen, this examiner has given me the net profit margin, and he has given me the sales. So the question is, how do I get the profit before interest and what here? Tax. Profit before interest and tax. Please make profit before interest and the tax here the subject of the formula. If you make this PBIT the subject of the formula, then we shall come and talk about PBIT being equal to the net profit margin times the sales. Net profit margin times the sales. So I want us to do that for the two divisions. So we have division A and we have division B. Division A and division B. So for division A, are you able to see the net profit margin for division A? Net profit margin for division A. In that question paper, you can see the net profit margin for A is 28. So 28% times the sales of company A. Company A sales, ladies and gentlemen, they have given me 44.6 million. Could you kindly give me this figure, somebody there in the comment section? Please punch 0.28 times 44.6. Give me a figure to write. Performance measurement, this never misses in your, you will be able to see in your exams. From your past papers, you always find out this. You always find this in your exams. So 0.28 times 44.6, what figure are we getting? Somebody there, please talk to me this evening.
12.488.
I'm being given a figure of 12 point. Is it from only one student or many students? Many, thank you very much. How about B? B, take the profit margin. times the sales of the company. So the profit margin here is 33% times the sales of the company, which happens to be 21.8. So 30% times 21.8. 30% times 21.8 times 21.8. What figure are we getting?
7.194.
7.194. 7.194. And then now you can come back to our formula of ROI. We can come back to our formula of ROI, return on investment. Return on investment. Fortunately, these are things that you even did in CPA section 1. CPA section 1. So how do we get return on investment? We have the formula. It is a profit before interest and tax divided by capital that has been employed. Divided by capital that has been employed. So ladies and gentlemen, come and give us ROI for company A. Company A, do we have the profit before interest and tax? Yes, I can see it here. It is 12.488. Right? Divide this by the capital that was employed in division A. The capital that was employed in division A, ladies and gentlemen, is 82 from the question paper. Is 82 point what here? 0.8. 82.8. 82.8 times 100. Please navigate that paper always between myself and the paper. It's important they get to see the paper as well. So you can see, ladies and gentlemen, return on investment for A, I'll take the profits that were yielded divided by the capital injected into this particular division for the project times 100. How about B? B, ladies and gentlemen, what do we have here? For B, we have the profits 7.194 divided by the capital that was employed. The capital that was employed, ladies and gentlemen, there are capital employed, ladies and gentlemen, for division B. I can see up there, it's 40.6, 40.6, 40.6. So please give us a figure, give us figures. We start with the first one. We start with the first one. And remember, if you have never used Zoom before, it's a very friendly system. You should keep on doing what? Oscillating between the handout and between what here? My face. If you want to see my face, you click on the face. So you have a big screen there. You want to see the handout? Keep on playing around with that. So come and give us ROI for division A. Somebody talk to us. ROI for division A. What do we have there? I'm waiting the figure for ROI of division A, my great students. What are they getting?
Getting different answers.
The same answers, eh?
For example, mostly they're starting with 15.08.
The first one, I'm being told here for A, is 15.08%. 15.08%. How about ROI for B? ROI for B, you simply write B equals. You simply say B equals. ROI for B, what do we have there, my friends? ROI for B, what do we have there, our friends?
17.72.
17.72%. So between the two divisions, ladies and gentlemen, which division will you tell us is performing much better than the other on the basis of ROI? Which division is posting a better performance? I'm waiting for them to tell me the better performing division. B. Remember, the higher the ROI, the higher the ROCE, the better the performance. The better the performance. After all, even project A will not be accepted at all. Why? Because the 15.08% is less than the hurdle rate. Is less than the hurdle rate. Hurdle like this. Hurdle is less than the hurdle rate. Le kuruka. Ya mbio ya kuruka. Kiswahili ngumu sana ile. No. So wametuambia kule juu kabisa, ladies and gentlemen, that at present there's a paragraph starting with historically. Historically, investment decisions have been made by calculating the ROI of any opportunities, and at present the ROI of each division is 16%. The current ROI becomes your hurdle rate of getting to know whether we should accept a project or not. There is no way we can ever accept a project whose ROI is less than the current. Currently, we are at 16%. We can only accept projects whose ROI, ladies and gentlemen, is more than, like now this is more than. Now this is more than 16%. Therefore, accept. This one here we're going to accept. This one here we rejected long time ago. We rejected that long time ago. We rejected that long time ago. So we are saying 2 points there. That number one, project B is performing much better, and it happens to be the only project which you can accept because it has got a ROI which is more than the current ROI. It has got a ROI which is more than the current ROI of 16%. Project A, of course, I can see it's not badly off 15. It's a high return, remember, it is a high return. However, the figure happens to be less than 16%. The figure happens to be less than 16%. So please allow Mwalimu here to check on the performance of those two projects this time round, ladies and gentlemen, using residual income. Using residual income. Yes.
My master request saying, can you allow us a few minutes to pray?
We pray for how many minutes now? Today's class. So I can give you like 5 minutes only. Prayers are important. 5 minutes only. Only 5, tafadhali. We will extend the class by the same number of minutes. I'm so sorry for that. But equally, it's important for even Christians to pray. It's important, yes. It's important, yes.
It here.
For the ones who are going to pray to come back, they could be looking at May 2018. May 2018, question number 5A. May 2018, question number 5A, and they could do for us the ROI. They could do for us the ROI for that particular question. May 2018, question number 5A, Roman 1. Let them have a look at that. Comments there. May 2018, question number 5A. May 2018, question number 5A. And I like how Kasneb keeps on stealing questions. Keeps on stealing questions from ACCA. You get to do so many questions of ACCA, you get a present, you get an award. So is there somebody who has been able to give us an answer for Roy, for B? Roy for B. The first student who has gotten it right is called Ever Mararo. 16.88 is correct for B. How about C? I want to get that figure now from another student, if possible, the boy child. The boy child, they should never be left behind. That's Edith, eh? Edith is getting what figure for C?
18.38.
Boniface, eh? Boniface, thank you very much for representing us and representing us so well, for that matter. So our Muslim friends, have they come back? Our Muslim friends, have they come back? We want to continue. So this May 2018 question number 5. Have we gotten those answers, all of us? The first one, ladies and gentlemen, which is supposed to be the correct figure for B, is supposed to be 16.88. And then the other one is supposed to be 18.38. Carrie is saying that our screen is frozen. So our screen is frozen. That must be network from her side. Network from her side. Network from her side. So I can see the Muslim friends saying yes, they have finished praying. But I don't know whether Faith Ogachi is coming from the Muslim community. But there's a possibility. Now, ladies and gentlemen, we go straight away to the second part of this question. My administrator, able administrator, please show them the question. Show them the question, question number 3 of Brace Company, of Brace Company, of Brace Company, of Brace Company, of Brace Company. So, in the requirement, they wanted us to calculate both the return on investment and residual income of the new investment for each of the 2 divisions. Already we have done ROI. Now we want to do the residual income. The residual income. Now, could you kindly give us the formula of residual income? Give us the formula of residual income. Residual income equals what? For a present, I need to give somebody a present. That reminds me that I owe somebody who got this question, some question correctly yesterday over AFM. I'll be forwarding the M-Pesa. So here we are. residual income equals what?
Edith is saying, this was the first one. PBIT minus COCO.
Very good. So residual income, according to Edith, it should be operating profit, which is profit before interest and what year? Tax, or EBIT. Minus Coca-Cola. Minus Coca-Cola. Minus Coca. Minus Coca. And this Coca, if you can recall, Coca stands for what in full? Cost of capital employed. Cost of capital, done what year? Employed. Cost of capital employed. Fortunately, we happen to be having our PBITs. What I only need to do is to come straight away and plug in the figures that I have for residual income of company A, which will be equal to PBIT for 8 was 12.488. 12.488 minus the cost of capital. This examiner had given us the cost of capital up there, where he told us that the cost of capital for both divisions is what percentage is 12%. The cost of capital for both divisions is 12%. So 12% of the capital employed, of the capital invested. So it will be 12.488 minus 12% times the capital employed. And what is the capital employed? Dear somebody, capital employed. Capital required for A is supposed to be 82.8 million. So please give us a figure, 82.8. We should be able to get residual income. We should be able to get residual income. So this minus 12% times 82.8. Please give us a figure. We put it down. Give us a figure, we put it down. What do we have over here? What do we have over here? I'm not hearing my students talking, really. I'm not hearing my students talking, really.
I'm getting a 2.5.
2.5?
52.
52.
I don't know why others are getting 2.522.
2.522, eh?
It's 2.552.
2.552, I'm told.
But there are others who are getting 2.522.
No, this is something that we can prove even ourselves. We have calculators here. So is this figure correct, my great students? 2.552? Thank you very much. How about residual income for company B? Residual income for company B, 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 residual income for company B. What do we have over here? Residual income for company B, this will be equal to, ladies and gentlemen, residual income for company B. I grabbed my profit. Who is able to remind us that the profit here, somebody? Who is able to remind us the profit here?
But they are giving it 7.194.
7.194 as the final answer, or the profit? Profit, minus the cost of capital is cross-cutting, 12% multiplied by the capital employed. The capital employed in B was 40.6. So then you should be able to give me the final answer. Please give me the final answer.
2.322.
2.322, like that. 2.322. So then at the end of the day, ladies and gentlemen, we shall always work with the project that has got the highest residual income. The higher the residual income, the better. The higher the residual income, the better. So in this case here, if we are correct, it is division A that should be undertaken. If there is capital limitation, then we undertake project what here? Project A. Let's undertake, we undertake project A on the basis of residual what here? Income. On the basis of residual income, undertake project what here? Project A. So let us repeat the same concept, ladies and gentlemen, using question number 5. We repeat the same concepts using question number 5. Highway company. Highway company. Please project it for them. Highway company. Highway company is a railway company. Are you able to see question number 5? Question number 5, we are told Highway company is a railway company. Highway company operates a passenger railway service and is responsible for the operation of services and the maintenance of track signaling equipment and other facilities such as stations. In recent years, it has been criticized for providing a poor service to the traveling public in terms of punctuality. Quite bad that we have trains which are not punctual. They told us to be here at 6, but they came at 6:30. So punctuality, safety issues, and the standard of the facilities offered to the passengers. In the last year, Highway company has invested over 20 million in new carriages, station facilities, and track maintenance programs in an attempt to counter these criticisms. Summarized financial results for a Highway company for the last 2 years are given below. So below there, I can see the incomes. I can see sales revenue. I can see a very important statistic in performance management and measurement, what we are calling the earnings before interest and tax, EBIT. Those figures are quite important to me. Then we have interest, we have taxation, and then lastly, we have earnings available to ordinary shareholders. So they have given us a summarized statement of financial position as at 31st December 2013 and then 2014. So we have the non-current assets, net. We have current assets, inventories, receivables, cash. And then they have given us the ordinary share capital, right? They have given us reserves, amounts payable after more than 1 year. Amounts payable after more than 1 year, ladies and gentlemen, those are long-term liabilities, of which you have got 8% debentures, 8% debentures, 8% debentures, and then we have bank loan. Then we have got short-term liabilities. Short-term liabilities are the ones they're giving us there as payables due within 1 year. We call them the current liabilities, the current liabilities. So they want us to do something very easy. They want us to calculate the following ratios for a Highway company for 20x3 and 20x4, clearly showing your workings. The first one being the return on capital employed, also known as return on investment, based upon closing capital employed. So I would want somebody to give me this answer on ROCE. This ROCE should come from you. This ROCE here should come from you. For me, what I need to do is to get its answer, and then we compare. We compare with the answers you're getting. Some good students, please calculate the ROCE for me for part 1. I'll give you a present. I'll give you a present. ROCE for part 1. The comments, eh? It's important for us to see the comments. Very important. Already they have gotten the answer. No. They haven't gotten. They haven't gotten that. Those are answers for the last item that we did.
Someone will take now. Come on, raised the hand.
The hand. You can just unmute the person. Unmute the person to talk. Yes. Once you raise your hand, we'll mute you and then you talk to us. Unfortunately, the student who has raised the hand there has saved himself or herself as techno.
Heading. I just wanted the question. Kindly project on the question, please.
Oh, we project the question, eh? Fine. Okay.
Yes.
Oh,
Thank you.
Okay, no, the question, asking the question is big up. I need to scroll.
You'll be scrolling, yes. Number 9. Bobby. Nitumia pesa yake mahali. Nitumia pesa yake na hizi kutoka. Na sisi pepa la kwa nini? Kwa mzee kama anaenda kama. Kwa mkono yake naye. Fanya sababu anatumia zake na akaambiwa gasi imeisha. Ndio niko fast. Akaambiwa gasi imeisha, so mimi
Net assets. Net assets minus current liabilities.
sawa. Sawa. So yes. Is there somebody who has been able to give us that answer? A question, eh? Anybody who has been able to give us that answer, please don't fear writing anything. Just write any figure you are getting there without fearing anybody. You know, the essence of this online classes, basically what makes it very interesting is that all of us are working on these things here from the respective homes or even offices. So don't have to fear anybody. Simply write there. So don't even scroll from the beginning. What is important here is the balance sheet. What is important is a statement of financial position. Statement of financial position, this one here. This is the most important part. Most important part. In calculations of ROCE, I don't want so much information. In calculations of ROCE, I only need the statement of financial position to be able to get the capital employed. And then number 2, of course, the income statement for profit. So come and give us the ROCE here. So our ROCE, ladies and gentlemen, or ROE, equals operating profit, which is profit before interest and tax divided by the capital employed. And this capital employed is what we are putting a star there. The capital employed is the same as net assets. At times, the examiner will not give you the capital employed directly. When he gives you a balance sheet, when he gives you a statement of financial position, he expects you to calculate the net assets yourself. And how do we calculate these net assets ourselves? It's very easy. You'll come and read the total assets figure. Total assets figure minus the current liabilities. Total assets figure minus the current liabilities. Total assets figure minus the current liabilities. Minus the current liabilities. So we take the total assets minus the current liabilities. So then I would want us to take this opportunity to calculate our net assets for the respective years for 2013 and 2014. So the total assets from the statement of financial position given there, the total assets I can see for 2013, I can see a figure of 114. 114. Because how do we get total assets? It's the non-current assets plus all the current assets. So I can see the non-current assets in 2013, there are 100.4. And then the current assets, when you add inventory, receivables, and the cash, I can see 13.6. So you take 13.6 plus 100.4, I'm able to see 114 as my total assets here. On the same year, I'm on the lookout. I'm watching there. I would want to get out what they are calling the current liabilities. Please go to the liability section. You will see under liability section if my statement of financial position is displayed. If my questionnaire is displayed, you'll be able to see under the amounts payable, we have amounts payable after more than 1 year. I'm not interested with that. I'm interested with the payables due within 1 year. Those are the current liabilities. Those are the current liabilities for the year 2013. I can see 8.4 here, 8.4. So could you kindly give us a figure? 114 minus 8.4 gives us what figure? 114 minus 8.4 gives me what figure as my net assets? 114 minus 8.4 will give me what figure at the end of the day?
105.6.
105.6. How about the year 2014? So we just conclude on this net assets concept. So the year 2014, am I able to see the total assets in the year 2014? Oh yes, I have 132.4 minus the current liabilities for that year, which I can see as 9.2 like that. So 132.4 minus 9.2 will give us what figure? 132.4 minus 9.2 will give us what figure, ladies and gentlemen?
123.2.
123.2. Thank you very much. Now, having gotten those two figures, then I can very comfortably give my examiner the return on investment for this company in the year 2013. So in the year 2013, I'll pick the profit before interest and tax of 2013, which I'm able to see as 18. So I'll take 18 divided by the net assets in the year 2013, which are 105.6 times 100. So please give us a figure. Come and do the same for 2014. You pick the EBIT. Earnings before interest and tax are the same as profits before interest and tax. So EBIT for the year 2014, I can see 16.5, divide this by 16.5, divided this by the net assets in 2014, which are 123.2 times 100. So please give us these figures. Give us these figures pretty fast. Like this is a very possible area. I wish I was still a young man setting forecasts. Nowadays I don't set for them. Days I really used to know these things. So please give us these figures. Today I'm not as fast as you guys are supposed to be.
First one is 17.0.
The first one, I'm being told here, is 17.05%.
05.
Is that coming from many students?
I think many of them are rounded up, but the actual the bigger figure is 17.045.
045. That is still the same. Thank you very much. How about the second one for 2014?
It's 13.39.
13.39%, like that. Now, ladies and gentlemen, talk about the performance of this company as time goes by. As time goes by, on the basis of ROI? Are we seeing a good trend or a bad trend? On the basis of ROI, are we seeing a good trend or a bad trend? A bad trend because, honestly speaking, we know that in the interest of time span, the more we are in business, the more our returns should be increasing. So we always expect a ROI, an increasing ROI trend. When we see ROI, ladies and gentlemen, going down from 17.05 to 13.39, then that means what here? Poor performance. That means poor performance. That means poor performance. It's good you keep on just mentioning like that, poor performance. Go to Roman 2. Roman 2, this should be your question. Roman 2 is not my question. Roman 2 is your question. Roman 2 is your question. Net profit margin, net profit margin. I want to see whether there are students here who will be able to give us the net profit margin for the year 2014 and for the year 2013. So, and for you to be able to do that, I expect you great students here to write for us down the formula. You start by writing down the formula of net profit margin. The formula of net profit margin. The formula of net profit margin. So the formula, ladies and gentlemen, for net profit margin, we don't talk of profit after tax in terms of margins, unless you don't have operating profit. In terms of net profit margin, we'll take the operating profit, all over what here, somebody? All over sales. Operating profit all over sales. Operating profit all over sales. Operating profit all over sales. And remember that our operating profit is the same as the EBIT or the PBIT. PBIT. So EBIT all over sales. If you wish, come and multiply this with what here? 100. Multiply this with 100. So come and give us, ladies and gentlemen, the net profit margin for the year 2013. Remember, if you have a question, you raise up your hand. We'll be able to give you an opportunity of talking to us, of addressing the congregation. So for 2013, ladies and gentlemen, I can see the EBIT up there is 18. I can see the EBIT up there is 18. 18 divided by the sales. So sales, I'm able to see from the income statement in the year 2013, the sales revenue was 180 times 100. This will end up giving us what percentage, my great students? So we have 18 divided by 180 times 100, which will end up giving us what figure?
So 10.
10%, thank you very much. So on the same breath, go and calculate the NPM of this company in the year 2014, the same concept, EBIT of 2014, EBIT of 2014, I can see, ladies and gentlemen, is 16.5. Divided this by the sales. The sales of 2014, we have 185 times 100%, which will end up giving us what figure? So 16.5 divided by 185 times 100. What do we have there, somebody?
8.92.
8.92. And of course, I've got a comment to make there that we can see there is a deteriorating what here? Performance. The performance is deteriorating. The performance is deteriorating. From there, we go to the next Roman 3. Roman 3. Roman 3, assets turnover ratio. Assets turnover ratio. I would want to see whether there is a student who will be able to remember that formula for us. Assets turnover. Assets turnover. Assets turnover. Assets turnover ratio. Assets turnover ratio Is there any student there who is able to remember the formula and write for us down? Assets turnover ratio equals what?
You have to say cost of sale or average stock.
Average stock, quite a good trial.
Then it did say sales over capital employment. Then Jenga, revenue, stock assets.
Yes, ladies and gentlemen, for us to get these assets turnover, this is how I normally look at this. Assets turnover. It's like there's an over there. Assets over what here, somebody? Turnover. But now remember, if you're using this approach, don't go for it literally like that. Remember here, things are turned over. They're turned over. So in short, turned over means that you start with turnover. So you start with turnover. You start with turnover, 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 all over what here, somebody, turnover, all over what here, assets. Now listen to me, turnover is the same as sales, all over assets. And remember, for purposes of performance measurement, the assets that make sense to us are those assets which will be with us in the long term. If there are assets that have been financed by short-term liabilities, you need to subtract those assets here from your total assets because you know the owners will be paid in the short term. And that is why we normally talk about assets for performance measurement. We normally make use of what we call net what here? Net. Please don't forget that net assets, don't forget that net assets are the same as capital, capital employed. These are the same as capital done what here? Employed. They're the same as capital employed. And if they're the same as capital employed, a good student should be that student who will be able to remember the formula of getting net assets, where our net assets will be equal to the total assets, which will be equal to total assets minus current liabilities. And if my memory serves me well, we are down the net assets for the year 2013, and we are down the net assets for the year 2014. Will you kindly remind us these figures? Kindly remind us these figures. Kindly in the comment section, remind us the figures, give us the net assets for the year 2013 and net assets for the year 2014. 2013 and 2014. Are they talking? Not yet. I'm waiting here. Waiting to hear from them.
2013, 105.6.
2013, we are going to a figure of 105.6. How about 2014?
2014, 123.2.
123.2. Thank you very much. 123.2. 123.2. Now, having gotten this, come and now plug in these figures in the formula. The assets turned over. The turnover has to be on top. The assets turned over. And remember, turnover is on top. The denominator, we have assets, but specifically the net assets. Net assets are the same as what your capital employed, as Edith is telling us. So then, ladies and gentlemen, we have there, I would want us to calculate the assets turnover for the year 2013. Assets turnover for the year 2013. So for the year 2013, ladies and gentlemen, we have our sales. Our sales for the year 2013, they are what here, somebody? 180. Divide this by the net assets of 2013 that you guys have given me a figure of 105.6. Please give us an answer. 180 divided by 105.6. 180 divided by 105.6. Please give us a figure. Of course, assets turnover cannot be in terms of percentage. assets turnover can't be in terms of percentage, what figure are they giving me there? What figure are they getting, ladies and gentlemen? I'm going to change the batteries a little bit. So clarity. They're saying what figure?
Mostly I'll give you 1.7.
1.7 times. So you can see that our assets, or rather our sales, is able to cover our assets how many times? 1.7 times. Very, very important. How about the assets turnover for the year 2014? I should take what divided by what here, somebody? 185. 185 divided by the net assets of 2014, which are 123.2, which will be equal to what here, somebody?
1.5.
1.5. Thank you very much. So then what will be your comment in terms of the performance of the entity on the basis of assets turnover? Is the performance improving or deteriorating? For purpose of making it easy, tell us whether the performance is good or bad. Good or bad?
It's bad.
It's bad, yes. Remember, the higher, the more we are able to cover our assets, the better, the better, the better, the better, the better, the better, the better. So in this case here, our performance is deteriorating. Poor performance, that one mark will give you a mark like that. Now from ladies and gentlemen, we go to the next one, which is current ratio. And for sure, current ratio, I cannot compute current ratio. I expect you great students of mine to give me the current ratio yourselves. The current ratio yourselves. Current ratio yourselves. Tell me what do we have there. Current ratio yourselves, and then you tell me what you have there. Current ratio yourselves, and then you tell me. So is there somebody who has been able to give us the current assets, all of our current liabilities ratio? Remember current ratio is the easiest ratio that will be able to earn me a mark without really struggling at all. I will not struggle with this. Ladies and gentlemen, for us here, to be able to get what we call the current ratio, CR. To get CR, we normally take current assets all over current what here? Liabilities. current assets all over current liabilities. So please go to the statement of financial position and try reading those figures for us. Like a good student in the year 2013, a good student ought to have seen that the current assets, which are in inventory, receivables, and the cash. Under 2013, we are supposed to talk of 13.6. Current assets, we have 13.6 there. All over current liabilities. Current liabilities, what do we have? Payables due within 1 year. Payables due within 1 year, 8.4. Thank you very much. So please give me the current ratio. CR stands for current ratio. CR stands for the current ratio. So current assets over current liabilities. What do we have here? Somebody? I'm waiting to get your answers very fast.
Most of them are getting.
Most of them are getting.
The first one was 1.6.
1.6, eh?
Yeah.
Thank you very much. So 1.6, remember the presentation for current ratio, you should talk of 1.6 is to what here, somebody? Is to 1. 1.6 is to 1. 1.6 is to 1. Very good. I can see this is quite, looking at this individually, this means quite a good performance. Why? Because we can see straight away that our current assets are more than the current what here? The current ratio is more than 1. That means strong liquidity, strong position liquidity-wise. How about 2014, ladies and gentlemen? 2014, I can see straight away my current assets there are 11.9. Come and divide this by the current liabilities, which I'm able to see as 9.2 like that. So then this will give us what figure at the end of the day? So 11.9 divided by 9.2, this will give us what figure?
So getting 1.29.
1.29, ladies and gentlemen, is to what here? Is to 1. You must always add that is to 1. That's how you demonstrate broad and deep understanding of the subject. Broad and deep understanding of the subject. Now, ladies and gentlemen, the moment I happen to be having this, I should be able to do a commentary and tell the examiner whether we are improving. Like here, liquidity-wise, we are not improving. We are actually coming very close by what year? 1. So if we are not very careful, we'll run out of what year? Funds to pay our short-term obligations. So again, here we are saying that our performance is what year? Our performance is very, very poor. Reduction in liquidity is not something you should smile about. Remember, when you go to a company, following your payment, you ask for the CFO, you're told the CFO is not around. You ask for the CEO is not around. That is not normal. When you start getting those two holders of those two positions running away, then there is a liquidity problem. I don't want you to be running away. You guys as accountants at your workplace, ensure that you safeguard liquidity. Play around with your like payable days versus receivable days. Try as much as possible to delay paying your creditors, but for your receivables, always try to pressurize them. So you give like receivable days, 20 days. But payable days, you really negotiate with your creditors, even for 40 double. Those are some of the measures you could use. Now look at part C. Part C, they want us to suggest 3 non-financial, or B is briefly comment on the financial performance of it. That's what we've been doing, That we've been doing. And then C, suggest 3 non-financial indicators that could be used in measuring the performance of a passenger railway company. And explain why your chosen indicators are what here important. So the key performance indicators of any company that is in the transport industry doesn't have to be just trains. If, for example, today you are to buy a fleet of buses, a fleet of vehicles, ladies and gentlemen, what are the key performance indicators you'll be looking at for you to say whether you are doing well or poorly? But now remember here, they don't want you to talk about financial indicators. They don't want financial indicators. They don't want you to start talking about profits, about revenues. No, they want the non-financial indicators, the non-financial perspective, ladies and gentlemen. This area is particularly found under what we call the balanced scorecard. Remember, I'm following those notes that I gave you. I gave you some summaries of the things that you need to know. All the things you need to know in this topic. And the balance scorecard was one of them. Balance scorecard was one of them. Balance scorecard was one of them. And if you remember, ladies and gentlemen, we spoke about the balance scorecard being that particular instrument, that particular card, scorecard, which looks at the performance of an entity from 4 perspectives. And I'm so sure most of us have forgotten those. Could you kindly remind us those 4 perspectives and for us to say that your performance is balanced? Haujafinyilia mtu. Let's assume unapata profit in the billions, lakini umefinyilia wafanyikazi. Profit in the billions, finance zako ziko sawa, lakini umefinyilia nani? Umefinyilia, for example, customers.
People raise their hand. But others are giving us.
The one who has raised their hand, you must always unmute them immediately. They talk to us. Have you unmuted them?
Yes.
Yes, please. We have unmuted you. You could just take 1 minute to talk to us. When you raise your hand, we unmute you. Please don't again go silent. Or they decide to write. Yes. Because of time, I'll just beg to continue. Perhaps they could write their answers in the comments section. Thank you very much. Now, come, ladies and gentlemen, balance scorecard. I'm being told by my able administrator here that most of us have gone ahead to list those particular perspectives. Which perspectives are these?
Financial perspective.
So we have the first one, which is the financial perspective. Thank you very much. But we have to be doing healthy financially. Number 2.
Customer.
We have the customer perspective. Customer perspective. Customer perspective. Number 3. Internal processes perspective. Internal processes perspective. And then number 4. Learning. Learning and what here? Innovation. Learning and innovation. Learning and innovation. Ladies and gentlemen, there is really nothing much to talk about here. It's quite an easy area, but highly examinable. Remember, under financial perspective, the key performance indicators will be looking at our revenues growing every year. So get like the percentage growth rates of revenues. Are our profits growing every year? If I'm a CFO today, I'll be looking at cost containment. How to look at my total cost vis-a-vis the sales, and then ensure that the total costs are either contained, if not doing what you're reducing, if not reducing. Ladies and gentlemen, remember here, I always keep on reminding you of these big firms in a Safaricom. You'll get their revenues going up, but when you look at, for example, their workforce structure, those guys are still downsizing every other day. So it's important here. How about the customer perspective? The key performance indicators on the customer perspective, you can recall, you've got key performance indicators here. Key performance indicators, ladies and gentlemen. For example, I would want to see whether we are acquiring, so we have the customer acquisition. I need to measure this. A good company should be able to measure this. Number 2, ladies and gentlemen, we need to come and look at how these people are satisfied. So customer satisfaction. We have what we call loyalty. We have what we call awareness. All these are good things that myself, as a CFO or as an entrepreneur running my own company, I should be interested in these metrics. Am I able to acquire new customers every other day? If yes, then correct. Am I able to satisfy the customers that we have, like the students that we have here today? Are we able to satisfy them? Are we able to satisfy them? And then, ladies and gentlemen, we have the concept of loyalty. Are we able, ladies and gentlemen, to have these students of ours, every time they think about doing like CPA, even if it's after 10 years, they think about, for the Summit students, they think about Summit. For RCM students, they think about RCM. So we need to come up with a program, even for these online students, for these online classes. I'm so sure there are those students of us here, who have really supported us, like paying 100 shillings for every class, since we started, 2-3 months, since we started. Honestly speaking, if you are very good people, we need to say that for the subsequent classes, you need to be paying some smaller amount. Or even better still, they should reach a level where we tell you, just now, you are like a stakeholder. Continue. In this case, you're studying without paying. So we need a loyalty program, and that is why successful companies like Safaricom, they have the Bonga Points, great supermarkets, they have the Zawadi Points cards. It is awareness, it's all about what your publicity. If today you are working for a company which is not on social media, it's not on Facebook, then straight away people are not aware of even your product. So awareness is key. And the internal processes, ladies and gentlemen, the key thing that I'll be looking at here for the process to be saying that they're doing good, I'll be looking at the issues of what here defects. Yes.
Faith Ogachi is asking, how old should a company be to use a customer perspective considering the startups?
Considering the startups, even if it's a startup, Ogachi, the moment you've just hit the road, trust you me, the world of business is quite funny. There is nothing like winning. There is nothing in this case here that they'll give you enough grace period. No. You hit the road like this and ensure that you are able to acquire what here your customers. The few that you acquire because you've just started, and ensure that you are able to satisfy them. And the measure satisfaction by giving what here, by giving questionnaires. Like you saw, we circulated online questionnaires asking our students how we are faring on these live classes. And I got students who, of course, saying, well, we are doing well. But again, good students were able to give me great feedback. Remember, feedback is not good when it's only positive for you. No, even negative criticism, negative feedback can help you to improve. So we need every time to measure the satisfaction levels. And then even if it's a starter, the first client of yours, for example, you've just started selling land like this, and there's a client who is giving you repeat business, have some kind of a bonus system for that. Of course, startups will need awareness more than even companies that are at the mature stage. But again, in Kenya here, and that is why you realize that most of our companies, like I normally pity our auditors because they have been made to believe that we have got big four PwCs and whatever. Nothing. Even a small firm that believes in what we call awareness should be able to rise on that ladder very fast and hit even PwCs of this world. The only thing, when I talk to them in the East Park seminars, they'll tell me that the code says we don't advertise. Who teaches you so? There's nothing like that. If you open like this week's paper, you'll get PwC hiring a CEO of a big company. But at the bottom of that particular advert, Daily Nation advert, you'll get a place where they are saying PwC whatever offers tax advisory. They're advertising every time. How do you run an auditing firm without a Facebook page? Where you should be telling people, for example, my name is Onyango & Associates, and we do this and this, tax consultancy. It's important that you remit your pay. Keep on reminding people like that to have custom, to have your name being a brand in the market. And that is the kind of tools that I've used personally to grow my personal brand. Because remember, as a business, you have two brands to grow. Your own business, your business as brand, and your individual's brand. So come to the internal processes, and the internal processes are, if my processes are okay, the defects, ladies and gentlemen, we should always be reducing. We should hit a level where we talk of zero defects. I'll be looking at things like labor turnover. Labor turnover affects processes. I'll be looking at things like automation. Are you really going into systems? For example, there is a college which I'll not be able to mention here. Because of COVID, these people are thinking in line of coming up with a robot, so that when you come to like our reception here, you'll simply meet a robot there, you press on a few buttons and you're able to communicate with the robot. In case you want to talk to our receptionist, simply pick a phone there and talk to our receptionist, because we don't want that interaction, right? And again, that will be giving assurance to the public that this college, for example, is taking this COVID-19 so seriously. So it's a way of, again, branding yourself outside there. So remember also on the internal processes, we also get to look at the management. What kind of management models are you using? Like there is this one management model that normally stands out every other time. This one here of the 14 principles of FIO. The 14 principles of FIO, if you recall them, these 14 principles of Henry FIO, we normally say dot, you see USSR, and then you say what here somebody, oh, I hope my cameraman is able to see me up to there. So we have here DAD, you see, USSR, OIC, because even if you have got superior systems, but you have got poor management models, there is nowhere you will go. So that you see USSR, how many are these? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. 14.
Calvin is asking pardon point 3 under internal processes.
Under internal processes, we are talking about automation. We must automate our processes. Like now, look at the problems that we have as a college offering online. Every time you pay 100 shillings going back to Excel, no. Perhaps 2 to 3 months down the line, we should automate how we receive the revenues and how we even issue the codes. Like now you'll get one student, or rather you'll get one code being offered to all these. No. You pay, you get a unique code. And if you try to share that code, straight away disconnect you and expel you from the program. That is the kind of a system I'm talking about, processes. The internal processes have to work in a way that we boost our internal control systems. Now we are talking of the 14 principles of Henry Fayol. That, of course, this stands for disciplined workers, authority. I know you know these things from SG. There must be order in an organization, initiatives. We have in this case here, for example, the Scala chain. We have what we call the esprit de corps. Once you have workers who are not disciplined, then your processes will not work. And then lastly, we have what we call learning and innovation. And the learning, I'll be looking at the training hours, things like training hours. And the innovation, ladies and gentlemen, I'll be looking at things like under innovation. I'll be looking at the new products you produce, new products. Every time they talk about innovation in terms of new products, I know in Kenya here we have got only 2 companies which are said to be very innovative. All the others, all these people here, we are still sleeping, right? And I always give you examples of this bad company like EABL. EABL, ladies and gentlemen, these people are top class in terms of innovation. These are people who will sit down and think like, how comes people don't drink our Tusker? They realize that ladies here would want to drink Tusker, but the kind of Tusker that is in the market is bitter. So they give them the Tusker cider. How comes in this case here, these ladies don't want this and this? So they think, for example, they say that the bottles we make, the bottles we're using are masculine. They are like men, meant for men. So from there now, after that research, they're able to come up with what we call stout bottles. So these guys are very, very innovative, very, very innovative. And then of course, you can't leave behind our own brand, which is having a global sensation, what we call Safaricom. Safaricom is a powerful company. And what made me respect Safaricom, and that is why every month I have to buy their shares, because I know their shares in the next 2 to 3 years will be going for over 100 shillings. What made me respect Safaricom is the beating it got when Raila Amolo Odinga came and told his followers to resist. So people could resist during the day for an hour. But of course, after that, they could always open their phones because they wanted to check on whether somebody has sent them M-Pesa. So because of that innovation, on that particular year, when there was a resist order, their sales revenue grew by 15%, 15-point-something percent, because of what innovation. Then they have got clear targets. There is no way like now the new CEO can mess with the sales revenue of Safaricom. Even with this COVID, trust you me, you'll get even their profits this time around doubling. To them, it doesn't matter. It's a blue chip company, and for blue chip companies, we can't accept parameters to go down. Like for a blue chip company, the moment you have your earnings per share going down by more than 10%, a good CEO should always resign. But remember, in Africa, you're always better off dying than doing what you are resigning. So in this particular question, what have they asked us? Please take me back to that question. So while there, they want us to suggest 3 non-financial indicators. 3 non-financial indicators that could be useful in measuring the performance of a railway company. Could you kindly give me those key performance indicators? If you are to have a bus company today, what are some of the key performance indicators, non-financial, that you'll always consider? Someone talk to us tonight. This is quite popular. When you go to your past papers, you'll see what I'm talking about. So please give me those 3 key non financial performance indicators that will go outside there looking for.
Making fun it's about Gosinga.
About Tusker, oh, I don't take beer. With the kind of knowledge which I'm really thirsty of, I can't try beer, but I normally do a lot of research for them. I normally do what we call agronomics.
They are saying customer satisfaction.
Non-financial. Ladies and gentlemen, let me give you these figures, or rather these parameters very well. So the non-financial key performance indicators. They are very simple, very simple. Number one, the very first thing that I will look at, ladies and gentlemen, here is percentage of trains. Percentage of trains on time. Percentage of trains on time. Ndio maana kama kina cost bus. Hizi bus ingawa cost bus imepata shida hapa juzi. Lakini siku ile cost bus ilikuwa cost bus. Wakati Muhindi mwenyewe alikuwa before Fariki achie vijana wake. You could see that guy outside there. If he says a bus goes at 8:30, it doesn't matter whether there are people outside there. Because that is a key performance metric for him. He wanted people to trust that in terms of punctuality, they're number one. They're leaders, as others will follow. So percentage of trains which are what here on time. And why is this important? Why is it important? Ladies and gentlemen, remember the importance. Punctuality. Punctuality is important. Punctuality is important to customers. Is important to customers. Number two, percentage of trains. For example, cancelled. Percentage of trains are cancelled. Just like now, imagine you come to this particular class, you've bought your bundles for 2 hours, and then you get one who say, we will not have a class. And that is why myself as a team leader of this, I try as much as possible, right, to ensure that my classes, as I have promised, are delivered. Actually, I also personally try to be very punctual. Apart from today, there is a lecturer who took studio time, more time than expected. So percentage of trains cancelled. Why is this important? It's important because the reliability is important. Reliability is important to passengers. Reliability is important to passengers. Something non-monetary and yet very important, I will come and consider, ladies and gentlemen, the number of accidents, for example. Now, basically, straight away, people start shying away. I even know of some buses that were forced to change their colors, even their names, because their buses were very popular with what here accidents. So number of accidents, perhaps of course I have to put a duration, perhaps in a month or in a year. Why is this important, ladies and gentlemen? Safety is vital. And that is why I can only remind you of cost bus during those days. Look at the type of drivers they were employing. Waarabu wazee. Si vijana hawa akanyaga friend unasikia kimbize kabisa. Hapana, nataka pole pole. Because of passengers, in this case here, looking at them arriving safely. What was our kitambo? It could 80 kilometers per hour, even without any speed gadget. They could not exceed 80. So number of accidents, this is quite an important non-financial parameter. Then we have, ladies and gentlemen, for example, things like cleanliness. Trust you me. Customers really like this. Cleanliness is quite important because passengers will always prefer quality, and of course in this case here clean services, or rather clean clean trains here. Trains like that. Trains like that. And that is why you will see a company like Ethiopian Airlines. Ethiopian Airlines, ambayo imekuwa ni Simba hapa Africa sasa. In terms of cleanliness, those guys are top on the range, or top of the range. Top. There is no way our KQ here, from how they dress their staff, everything, top of the range. Cleanliness, especially the ablution blocks. Cleanliness is key. Now, ladies and gentlemen, if you don't mind, let's go to question number 1. So like now, if you are careful, already question number 4, we have tackled question number 4. Take them to question number 4 first. Question number 4. And this question number 4 is an ACCA question which has been asked here severally. Brush Company is an electronics company specializing in the manufacture of home audio equipment. Historically, the company has used solely financial performance measures to assess the performance of the company as a whole. The company's managing director has recently heard of the balanced scorecard approach and is keen to learn more. Describe the balanced scorecard approach to performance measurement. To performance measurement. Describe the balanced scorecard approach to performance measurement. I would want to give you only 1 minute. Only 1 minute. Try to do like a paragraph for us as a class exercise. A paragraph for us about this balanced scorecard. Just a paragraph without looking at my notes. Just a paragraph. Only 1 paragraph, and then I'll be able to advise you on what we need to do.
It's question 4.
Yeah, question 4. It's question 4, which is displayed on the screen. Question 4 displayed on the screen. Question 4 displayed on the screen. But the display is not working, No problem. But I'd also ask you to do it. We say, ladies and gentlemen, that you are to describe the balanced scorecard. The very best way of describing the balanced scorecard is to draw that diagram where you have got those 4 components, and then of course try to tell us that a balanced scorecard, ladies and gentlemen, basically measures the performance of an organization in 2 ways first. It captures the performance of an organization in terms of money. So we have here, it measures the performance of an organization using monetary performance, and then we have the non-monetary performance. And the balanced scorecard, you'll be surprised, the bigger thing is not money. The bigger thing is not money. The bigger thing is the non-monetary, the customer. We have the processes, we have the learning and what you innovate. You can imagine like right now what is happening to those companies that were not innovating. Most of the companies, after this COVID has been contained, unless the government comes and really tries to bail these companies, ladies and gentlemen, out, most companies will die. Sorry to tell you that, most companies will die. Because they never thought of what you're innovating. They never thought of innovating. They never thought of innovating. So these questions are so many there in your past papers, which I would want you to go and look at. For example, homework, the first homework is November 2018, question number 2B. November 2018, question number 2B. Please write that down. November 2018, question number 2B. And then we have November 2018, question number 4A. You can see, like in that topic, they gave us 2 questions from the same area. They gave us the balance scorecard, and then they gave us the ratio analysis. 2 questions. I told you that the key pillar of this thing is what here, somebody. The key pillar of the subject management accounting is performance appraisal. It's performance appraisal. It's performance appraisal. It's performance.